Well, you know what they say, all good things must come to an end at some point. The bulls have been on an absolute parade for the past 2.5 weeks, and it's high time the bears step up and take them out to pasture with some sort of market pullback or some sideways slowdown in the coming week's worth of trade. No, this is not a gambler's fallacy where we're imagining the market to pull back just because it's been up so aggressively. We are starting to see the deterioration in some of the charts that track the strength of the S&P 500, and that'll be the main thesis of today's Weekly Watchlist episode, where, of course, I do a full technical breakdown of everything that you see listed up above here, as well as present 4 trade ideas towards the end of the video. Anything that we're associated with is linked down below in the description. A quick thumbs up before we get started is greatly appreciated, and with that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've definitely got a bullish candle here, but the concern is in the upper wick. It certainly would represent some selling pressure up towards the highs of last week's range, but if we think about the magnitude and size of the candle body, paired with the fact that we did technically close in the upper third of the week's range, I would still say that the buyers have an upper hand from a structural perspective. From a location perspective, we definitely have ourselves a bar-to-bar higher low and a significant higher high. Once again, more bullish data points are stacking up. The reason why this is such a significant higher high is because we've closed and made a new higher high above the prior weekly pivot from November and December of 2022. Thus, we could say with a little bit more confidence that a weekly trend reversal is well underway. The current trend count would go as follows: lows, higher lows, highs, and now higher highs. This higher high has negated really the opportunity for a perfect double top pattern off of this area, and it doesn't necessarily mean that the market can't break down, but the odds of a breakdown have certainly decreased from that perspective. We can certainly look for a higher low pullback and afford a higher low pullback because of the higher high, but we're not necessarily looking for a breakdown of the double top neckline. And of course, this is all happening in the context of a break of the weekly resistance trend line and a recapture of the weekly 50 SMA, the blue moving average on your screen as well, which speaks to improved bullish odds in the upward direction. So once again, the market can see a pullback, but it will not violate or deteriorate any of the bullish structure unless we, of course, take out 380 in the coming week's worth of trade, which would be one heck of a volatility storm to see something that does this into Friday's close. Seems like a low probability outcome to me, but reasonable would be a little bit of a pullback happening here. Why else could we expect some pullback? Let's have a look at our volume profile chart. What you'll notice from here is we did tag the upper high volume node, roughly SPY 420, and that's where we found that little upper wick starting to develop. So once again, completely fine. We've hit the target. We've made a higher high, not unreasonable for the market to pull back and find a higher low. Speaking of higher lows from a volume profile perspective, we still have 390 as a key high volume node, and if the market were to pull back to it, from the weekly perspective at least, it would be respecting a higher low. Right, you can see that we would be getting something that would look like this. On the daily chart, though, as we'll see in just a moment, it would be less than ideal to pull all the way back to 390. We'll talk about that in just a moment, but I do want to point your attention to the next overhead high volume node, just perhaps in case we do get continuation and this proves to be the unstoppable trend. 440 is the next volume-based area, but once again, I'm not making any assumptions or advocating that we go there in the coming week's worth of trade. Let's have a look at the daily time frame chart and assess the weekly expected move, psychology, location, structure, all that good stuff. Expected move is up first. That is the gray box here. Lots of questions about this recently on the channel, so tutorial video in the top right-hand corner. If we're contained by the upper edge of the weekly expected move, the number there is $420.03. That would be bullish. It is a higher high above last Thursday's high. If we're contained by the lower edge of the weekly expected move, the number there is $404.70. That is also bullish, providing a higher low on the daily time frame chart. Notice that your weekly higher low level that we just discussed at 390 is way down here. Getting towards that area would not be ideal from a daily trend perspective. If we think about the daily trend count, just like we talk about the weekly trend count, we have lows, higher lows, higher lows. Pulling back to here would be a perfect higher low. In terms of highs, we have highs, higher highs, so on and so forth into last Thursday's high. Coming off of this higher high, the market can certainly afford on the daily time frame chart to search for some sort of higher low pullback, and we'll talk about why Friday's structure represents some selling pressure in just a moment, but I do want to quickly point out the line in the sand for the higher low pullback before we talk about the structure, and that would be here at $400.75. The main reason that the market must stay above from the daily perspective, $400.75, is because if we are to get underneath it and provide a lower high, you can certainly start to see how a head and shoulders pattern could develop, and that could be bearish underneath the weekly high volume node at 390. Doesn't look likely, and it does seem to me that the market could stay above this, noting that that's far extended through the lower edge of the weekly expected move, but $400.75 line in the sand on the pullback for this upcoming week's worth of trade. Let's talk about the structure from Friday now. This is what I would like to call an inverted hammer in and out type bar, not in and out burger, in and out type bar. The reason being is that we look into Thursday's range and then fall right back out of it for the close. We look inside, no acceptance, close fairly weak down towards the lows of Friday's session. To me, that would be indicative of longs not wanting to commit volume up here, not wanting to buy new money longs and hold them through the weekend for a breakout, signs of a slowdown. Now, the breakdown won't necessarily come until we breach 410 on the downside and get into the single prints from the FOMC rally on Wednesday. That number is 409.10, fills down to 406.50, and perhaps looking at this on the hourly chart will serve us a little bit better. So here we go. On Friday, you'll see that we had a rally, lack of acceptance in the prior day's range, and we fall out. I would chalk this up to liquidation break, and the main reason that we're not thinking of these folks as new money sellers is because we went right to the opening print, we went underneath it by a little bit in that lower wick there, and never got continuation in the downward direction, and we actually closed the day above the opening print for a green daily bar. So once again, we're still looking at this as a failure from the buyers, but it's not necessarily new aggressive shorts entering this market looking to push it to hell in a handbasket. So noting that is useful because in an uptrend, we're still trying to get involved on higher low pullbacks or equal high breakouts. And at this point in time, coming off of the higher high, we're looking for that higher low pullback. And once again, the argument could be made for the lower edge of the weekly expected move, 403.75, the area where the sellers failed on the FOMC initial drive lower, buyers stepped up, we know the rest is history, and the line in the sand is the breakout point here where we've already experienced a break, retest, and rally at $400.75. So overall, those are the numbers that I would be focused on if you are a market bull looking for reasonable pullback. If the market just gives us consolidation above 410, then my goodness, that is a gift. Rainbows and butterflies type consolidation, a break over Thursday's high for the equal high breakout, gets us through the gap here from 419.50, closes to 421.25, and then our next overhead target is 426. Once again, bit of a stretch for the coming week's worth of trade, especially considering we just made a brand new higher high. So that's what I've got on the upside. In terms of overlap for supports, let's take out our Fibonacci's from the lows of the breakout bar to the highs of last Thursday. What you'll notice is that the 38.2 Fibonacci retracement is right at that 403.75 area that we just identified as a key pullback area on the hourly and daily time frame chart, solidifying that this is an important zone if the bulls are going to find a higher low. If we go ahead and scrunch this chart up and have a look at our Fibonacci's from the low of the October move down here all the way to the most recent high, just updating the fact that the 38.2 here is now above the 390 high volume node. Once again, from a weekly perspective, this is a great level to find a weekly higher low. We do not want to go here from the daily perspective. Of course, the threat, as we've pointed out, is a lower high underneath $400.75. If we take out our looks of the anchored VWAPs. Wow, that was a rough one. If we take a look at the anchored VWAPs, there we are. What we'll notice here is that we're getting confluence of support right around that 403.75 area from the all-time high anchored VWAP, and that's pretty much flat. I would imagine it sustains this level for quite some time. This is aggressively perking up on a trajectory as follows. Coming from the anchor here, the original breakout bar, that is the dashed orange anchored VWAP, and this is a prior 2022 dip that's just going sideways, starting to ever so slightly curl up. Again, just building the case that this general zone zone is the line in the sand that you want to see hold if you are primarily bullish looking to get involved on the higher low pullback. Once again, the ways that you get involved on a higher low are to watch for hammer candles in here, are to watch for intraday double bottoms or intraday inverted head and shoulders. All of those patterns are valid at either the single prints close, 406.50, the lower edge of the weekly expected move, 404.70, or 403.75. This general area is a high area of interest for the higher low pullback in our SPY chart. Let's go ahead and put back on our regular moving averages, 50 in blue, 200 in green, and have a look at the market internals. What else can we learn about the market here? Top right-hand corner's got you covered with a brief tutorial if you don't know what this screen is. Overall, we do still have bullish inflows as of the close of the week on Friday, but note that they're not very significant, only making it to roughly 500 million by the close of the week, balancing out the extreme inflows on Tuesday with some outflows on the Friday close, making that negative 300 million impression. The advanced decline line is mostly scattered throughout the week, some acceptance underneath, some in bull trend zone, some near zero, higher, lower, right? So a mixed bag in the advanced decline line, indicative of some slowdown. It's not as bullish as it could have possibly been. A much more bullish look would be to see something that does this, maybe sideways for a day here, right? Something that does this. Just simply wasn't the case. Once again, more of a mixed bag, indicative of some slowdown possibly being around the corner. And the same thing holds true in the tick. Very bullish reads on Tuesday, balanced out with a flat read on Wednesday, pretty much flat on Thursday, a little bit bearish, not so much when you compare it to the bullish nature of Tuesday. Once again, that mixed bag, sort of indicative of a slowdown out there across the underpinnings of the market. You're starting to see some rotations. It's not just buy, everything and anything. Let's have a look at our market profile. What can we learn from this chart? If you don't know what this screen is, top right-hand corner's got you covered with another tutorial on how to set this up, what it all means, all of that good stuff. The main takeaway here is the value area shift from Thursday to Friday. Notice that it's overlapping to down, and most importantly, the point of control, the neon line right here, is actually underneath the low of Thursday. So just like we talked about the in and out candle on the inverted bar on the SPY daily chart, the point of control actually did migrate lower with price and stayed underneath Thursday's low as well. Does strike me as being slightly more bearish than bullish. Again, indicative of pullback or possible slowdown early in the coming week. We don't have the greatest excess at the highs and lows. I suppose we've got 2 ticks of excess here and here at the lows if we zoom in just a little bit, but those levels could use a little bit of minor repair. I would call it lack of material excess, as Peter would say from Shadow Trader. And we do have a VPOC, Virgin Point of Control, to possibly tag up to around 40.80 on a pullback. So if we break down underneath that SPY 410 area, this is roughly the equivalent of pulling back through the single prints, right? This is, of course, the single prints right here, and making it closer to that 403.75-ish area on your SPY daily time frame chart. So once again, just building the case that value shifting lower, point of control discernibly lower as well, and underneath Thursday's low definitely would speak to improved odds for pullback, but not outright deterioration of our market. Let's get back on over to the platform here and talk about our sectors. The main takeaway is that we are still seeing risk on positioning from a weekly performance perspective. Notice XLC Communications top of the list here, 6.32%. XLK Tech Sector up 4.91, followed by the XLY Consumer Discretionary 3.11%. At the bottom of the barrel, we see the energy sector, the utility sector, and the healthcare sector, all of which, as we know, are risk-off sectors. So bullish posture still remains true. Let's take a look at the structural charts and evaluate what's going on with the trends here. Very hard to say anything bearish about the XLC. Big gap up and a hold for the most part on Friday's session, but once again, you could call it the rough beginnings of an in and out candle. We didn't technically close underneath the Thursday low, but if this is to pull back and start to close some of the gap, you could imagine that would of course manifest as some downward pressure for your SPY. So a main theme of looking at all of the sectors today is that yes, although the risk-on performers are outperforming, they're up towards the top of the list, they certainly could see some pullback, which would be reasonable from a structural perspective, but of course, that would mean some red action intra-week for our S&P 500. So pay attention to the gap in the XLC, noting that that's the primary concern of these charts. Let's speed it up a little bit through the remainder of them. XLK, once again, looked above the prior bar's high, no acceptance from the buyers, didn't close underneath Thursday's low, but are we a bit extended here? Could the market see a pullback based on that failure from the buyers over Thursday's high? Absolutely. Higher lows want to form over 135. So watching 135, but once again, to get there, intra-week downward pressure for your S&P 500. Ideal rainbows and butterflies stays above 139.25. Becomes concerning underneath 135, right? Reason being is we're back inside of this balance area here. Most heavyweight sector for the market, we spent some time on it. XLY, consumer discretionary, once again, in and out candle, closing the overhead gap, closing weak towards the lows, back inside of Wednesday's FOMC rally. Once again, this would certainly be indicative of the buyers running out of steam, so to speak. Could we see a pullback? Absolutely. Ideal rainbows and butterflies holds 148, the top of the balance range in here. Anything underneath that is still okay. You can easily make the argument that we have lows, higher lows, anything kind of above this gap area is still a easy higher low on your XLY chart. Not great that we're falling back down into this balance, but also not the end of the world from a structural perspective. Think about how fast this rally took place. We could easily meander sideways for a bit, consolidate into some sort of meaningful pennant, and then go from there. So once again, risk on sector, worth spending some time on. The main level, 148, and then your gap underneath. Still strikes me as bullish, but intra-week could provide some pullback, right? XLI, industrials, bull flag happening on the weekly and monthly time frame chart, failing to break out over the highs. Reason we could say that is that you can see this upper wick here, close above, and then comes back down into range on the Friday session. It's an inside bar, so watch out for a breakdown of that low. The higher low that you want to see hold is $100.50. That's the upper third, roughly, of this flag range up here. If we do something like this, opportunity to hold on to this as an ascending triangle. Anything underneath becomes slightly more bearish. Next up is the real estate sector. Has much more to do with the wealth effect, pulling back a little bit on the Friday session with rates going slightly higher, but still well above this breakout area here at 39.85. No major concerns here. Bullish force here, neutral back down there, and of course anything underneath 37.25 starts to become more bearish for the S&P 500. Lightweight sector, much more to do with the wealth effect. Anything that kind of noodles around in here strikes me as being very neutral for the market, not overly concerned with it. XLF for financials. Definitely worth noting here that we are seeing some relative strength on a structural perspective. Reason being is that we have this level and we're building out a nice solid balance area overhead. The market's not extending itself too far in financials, and it's also not breaking down aggressively. The longer we can kind of hold this, the better the base we're building of a bull flag and possibly looking for the breakout over 37. Next overhead target is 38.15. That would be a bullish force for the S&Ps. Coming down underneath 36 wouldn't be ideal, but there's still an opportunity for maybe a higher low somewhere around 35.50 possibly. I'd just keep an eye on that one. Not ideal underneath 36. Want to see it stay above. Next up is the XLP consumer staples. D for defensive, risk off in terms of its posturing nature. Notice that it's pulling back here. It's continuing to put in the staircase in the downward direction. Does strike me as being a-okay for our market. Once again, downward pressure is still downward pressure, but as it lags, that's great in terms of risk on posturing, and we just don't want to see it breaking down underneath 72. Goes sideways here, lag the market. That's a good look. Don't start falling off of a cliff underneath 72. So far, so good. No major concerns in the XLP. XLB for materials, really lightweight sector, fake break, more similar to the XLI, of course, looking for continued higher lows or consolidation around 82. And you could make the argument that we're just putting in a really elongated cup and handle type pattern like this. The fake breakout is maybe slightly concerning, but only if we start breaking down underneath 80.75, right? In that case, you would say, okay, fake break, and then underneath the neckline of a possible double top, that's where things get ugly. So far, so good. Want to see it go sideways. Once again, really lightweight sector. Let's move along. Next up, XLV, healthcare sector. I know this one gets confused all the time. It's the second heaviest weighted sector for the S&P 500. Therefore, if the S&P is going to see meaningful upside, it's very difficult to do if the XLV is falling off of a cliff, which it's not doing. However, it is D for defensive in terms of its posturing perspective. Remember, even if the market's going to zero, even if we're hitting a recession, grandma and grandpa still need their 32 pills in the morning and 52 at night just to make sure that they can make it through the end of the week, right? So therefore, because of the necessity of the healthcare sector, it's defensive from a posturing perspective. Hopefully that kind of continues to make sense. I'll reiterate it when we need to. So far, going sideways, all good here. No major concerns. The concern is when a big red bar comes and does something like that. Would we be concerned about that into the coming weeks worth of trade? Possibly. The reason I say that is the biggest constituents of the XLV, UNH, for example. Look at the hideous pattern on UNH daily chart. 3-bar play in the downward direction. 1, 2, and then looking for 3 to break down and continue in the lower direction underneath the 2 lows there. What else do we have? J&J, for example, Johnson & Johnson. You could say something similar. It's not a 3-bar play, but nonetheless, still a bear flag forming underneath this breakdown point at 169.30. What else do we have? MRK, Merrick, I believe, another heavy-weighted component in the XLV. 3-bar play, overall some weakness taking place here. So yeah, I would certainly keep an eye on the XLV sector as a whole. So far, it's holding up, it's going sideways, it's playing nicely here, but the threat is easily to the downside in the XLV, and that could expedite some selling in the S&P, especially if we're seeing a pullback in all of the other risk-on sectors that have dramatically outperformed over the past couple of weeks. So that's the main spiel on the XLV. Let's continue along and talk about energy. This is D for defensive. It's a risk-off sector. It's coming in aggressively. No major concerns because this is such a lightweight sector. It's less than 3% of your S&P 500. Utilities is going to be the same idea, right? D for defensive. We want to see it coming in. We don't want it leading market rallies. It's really lightweight, under 3% of the S&P, so no major concerns about this. The fact that the lower wick formed here, indicative of possibly sideways, if we can hold up kind of in this range, fine, go sideways. We don't want downward pressure for the markets, but we certainly don't want it outperforming. No major concerns in utilities. So that's been a look at the sectors. Let's have a look at our ratio grid. If you don't know what the screen is, top right-hand corner shows you how to set it up. The top 4 are the risk-on sectors. Notice that the XLK, dramatic improvements over the last couple trading days of the week, getting above the prior highs from in here. This definitely strikes me as a more risk-on, bullish look for our market. XLV, falling off of a cliff on the ratio perspective. We just hammered that home on the structural chart. XLF, holding up in that breakout zone going sideways. The longer it can hold there, the more powerful the breakout should become. This should perk up if the move is higher over the 50 SMA, the gold line on all of these charts. So not overly concerned with the breakdown here, but starting to keep an eye on it. And again, this would sort of be indicative of maybe we see some slowdown in the S&P for the coming week's worth of trade. XLY also starting to find a little bit of a pullback with that gap fill reversal that we saw on the structural chart. Once again, indicative of some healthy pullback possibly developing, but nothing overly jeopardizing the big significant improvements that we've seen thus far in this ratio pairing. XLC, a little bit of a pullback here. Once again, wouldn't be unreasonable with that gap we have to close underneath us on the structural chart for this to pull in a bit, indicating once again, you can hopefully sound or get the theme of today's video. Some pullback is not out of the picture for our S&P. Next up, the bottom 4 are the risk off sectors. Falling off of a cliff here, that's healthy. Falling off of a cliff here, that's healthy. Energy, same thing. Real estate, mostly sideways, has much more to do with the wealth effect. We do not have a current risk off look in our marketplace. Let's have a look now at the XLY over the XLP, which of course is representative of growth versus value, or basically risk on versus risk off. You could look at it in that light as well. Once again, aggressive move here, very significant move in the upward direction. Could it reasonably see some pullback? Yes. This one, it's very difficult to say. It's not like we're running into clear resistance at this top over here, and I guess we're right at the breakdown point from here. So maybe from a technical perspective, a little bit of resistance there, but it's a tough call. This chart overall still speaks to massive strength in our market instead of weakness. I would not just short this because it's quote unquote overextended. We've seen other evidence for a market pullback. This does not really fall into that category. This does still strike me as being incredibly strong. Let's have a look next at the dollar. What's going on with the Dixie over here? So some interesting things going on. Still definitely in a daily downtrend, looking for that lower high up against 103.50. Of course, the dollar is actually open right now, and you can see a little bit of a pullback developing. Still looking for that to rotate lower, which of course would be bullish for equities here. If we get into this area where we've chopped around sideways for quite some time in December, that of course would be more neutral, and maybe the opportunity is there for a market to see a little bit of a pullback. If we take a look at the gold contract, it's also confirming very similar things. Having a look here, the breakdown is far more aggressive in gold, but once again, can easily find a higher low off the top of this range at 1820. The concern would be, once again, if we fall back down here and then produce a lower high and break, yeah, of course, we're going to start thinking about the opportunity for a head and shoulders, which of course would be bearish for our equities down below based on the relationship with the dollar. The primary thing with the dollar coming in aggressively, if we just go back to the DXY, is the fact that this is going to possibly relieve pressure on Q1 earnings for stocks as we move into the next cycle, so to speak. A lot of notes have been made about the impact of currency in the Q4 earnings. So with all of that said, let's take a look at the TNX, which of course is the 10-year yield. This also perking up a little bit on Friday. We pointed that out in financials, as well as the XLF financial sector, still in this descending triangle, looking for the break here in the downward direction, but the perking up, not all that promising, right? So the Fed came out really kind of on par with their narrative that they've continued to push, which is, hey, I know the market doesn't believe us, but rates are going to be higher for longer. And speaking of which, let's have a look at that Fed tracker tool. What you'll notice is that they actually have bumped slightly higher, mostly due to the jobs data that came out on Friday. The market can withstand sort of higher rates. The economy, the underpinnings are all good, and we'll see that on the unemployment chart in just a second here. But 500 to 525 basis points being priced in as the terminal rate. One rate cut now to knock us back down to 475 to 500, and not a subsequent rate cut into the month of December to round out 2023. Now, good news was good news in my estimation on the Friday session. Remember that this relationship of good news being bad news and bad news being good news, it's it's gray area for the market. But at this point in time, I'm of the belief personally, and this is speaking to the macro narrative, not necessarily what we should do in the markets tomorrow morning at 9:30, macro narrative here. I think that good news wants to continue to be good news, because what that would tell us is that we are likely going to avoid the recession that everybody's talking about. If nobody's losing their jobs and people still have money to spend, sure, inflation is still high. We are seeing evidence that it's moving in the right direction based on the CPI and PCE data. Then who cares if the market is going to experience more rate hikes? You know, we know that consumer spending is still going to exist. Inflation is moving in the right direction. The economy wants to avoid the recession. From a macro perspective, it's all about the soft landing and avoiding that recession, not so much, oh no, the jobs data came in good. It means Powell can continue to raise rates, right? It's fine. Let him raise rates. Let the jobs data speak for itself. Good news will be good news. Speaking of earnings, let's have a look at Q4 so far. We're not doing great. We've got about a 65% beat rate, which is actually off of the average by a hair. And the most important part continues to be that forward guidance here for Q1. Notice that now we have many more companies that have reported. We've got 43, so 37 of the 43, 86% have guided negative for Q1, which is above the 5-year average, 59%, and 10-year average of 67%. For all of fiscal year 2023, of 251 companies, 129 have issued negative guidance, and of that, we are looking at a 51% ratio there in terms of the full fiscal year of 2023. So overall, continuing to keep an eye on this. Another interesting point about the earnings and negative guidance going forward is if the dollar continues to come in a little bit, and all of a sudden this negative guidance, which has been so impacted by the dollar rallying over Q4 of last fiscal year, right? It leaves a huge opportunity for outperformance when those earnings actually come out, which the market would see as a big boost, of course. So just because there's this negative guidance doesn't mean that it has to wind up being negative, and there's the opportunity for a beat. I, of course, want to stay as a realist and not an optimist, but that's one possibility. Of course, the other possibility is that, hey, they issued negative, it came in negative. Of course, that's going to impact the bottom line. Another thing that I oftentimes get screwed up in my own head is just because a company has issued negative guidance does not necessarily mean that they're not profitable, right? It just is a recommendation that, hey, growth is either slowing down or contracting just a little bit. It doesn't mean that we're hemorrhaging money per se, although in some instances it certainly does. Anyways, very, very fundamental for today's take. It's a midnight special. I'm feeling kind of snazzy with the fundamental take. Let's have a look now at the unemployment rate. What I want to show you is, of course, the numbers came out on Friday and they ticked to a new low. So once again, it's going to be very, very difficult for the market to see a big and deep recession in equities if this is sitting at lows. Typically, you need to see a big tick higher for something significant to happen in terms of drawdown in our market. Not to say that the drawdown from the 2022 highs, the all-time highs, hasn't been significant already. So far, so good from a jobs data perspective. Let's get back on track with the technicals here and speak to risk appetite. TLT not outperforming by any stretch of the imagination, actually falling out of this little consolidation box in the ratio relationship. So not seeing any flight to safety from that perspective. Let's have a look at the HYG. and see what's going on over here. Coming in a little bit, but certainly still respecting the lows. So risk appetite remains strong. The concerning look here would be a breakdown of those lows. Equities remains high. That's kind of your red flag to say, hey, maybe cool it just a little bit and look for that pullback. Once again, this would speak to the improved odds of a pullback, not outright deterioration if we break underneath those lows. So keeping an eye on the HYG. What else? We've got the Bitcoin chart, which speaks to risk appetite. Let's have a look over here. And all I would point out about Bitcoin is just zooming in, we're still above the breakdown candle high, even with some pullback and volatility, very minor volatility in the grand scheme of things. Last week, we're still above that level, which is 21.5K in the Bitcoin chart, speaking to improved risk appetite. Let's have a look at market breadth indications. First up is the new highs minus new lows. Continues to look great. We printed a weekly read, highest we've seen yet since all of 2022, going back to the very end of 2021. So a really great look there in the new highs versus lows. Let's have a look at our SPX A200 ARC. Percentage of companies in the S&P over the 200 made a new high tick here. Once again, speaks to improved bullish odds. Not really a threat of a major massive drawdown here. And also, if we take a look at the 50 SMA stock, so stocks above the 50 SMA in the S&P, this is turning down ever so slightly. It never got into the contrarian sort of perspective of 0.9 or higher. And once again, if the market's going to experience a pullback, it wouldn't be unreasonable for this to break down, find support here above the 50% mark, and we're all good. Not all that bad of a deterioration in the underpinnings of our market itself. RSP, equal weight S&P 500 versus the weighted S&P. Notice the stronger opportunity for a higher low here versus the equal weight, or excuse me, the regular weighted S&P underneath. It's like do or die, right? So definitely a stronger opportunity for the overall breadth of the market to find the higher low and preserve bullish structure underneath us without taking into consideration a couple of bad apples that are weighing in the downward direction. Now, one of the issues that we brought up in the Wednesday update was the Dow Jones divergence, and it's still very much so in play. Notice the massive higher high that was made in transports, whereas industrials has not gone anywhere. This continues to be a red flag and would speak to improved opportunity for pullback, specifically here, and let the S&P come in a little bit. If this wants to break out and start to confirm that look, that'll be a different story, but so far I would side with the sort of pullback and consolidation type look, and that this is not really going to be a sustainable type move in the transports. So that is all I've got in the underpinnings of the S&P and some comparable looks. Let's have a look at volatility now. Continues to remain low, depressed, meaning that this is certainly being recognized as a reasonable pullback, a decent higher low. On the weekly time frame chart, nobody's kind of up in arms about, this being a secure bottom, at least at this point in time. Now, as we know, when volatility remains low, it does open us up to the flood effect, and that's what the VVIX is telling us here. Nobody is currently hedged properly for a massive sell-off with SPY puts, or nobody's going out there and buying VIX calls either. So if everybody rushes in all at once, this should spike and give us the advanced heads up. As of right now, not a concern for our markets. Let's have a look at the volatility futures, indicating Contango here. There was a little bit of divergence in the futures versus what was going on in the 9 versus monthly VIX here. And that was primarily as we were leading up into earnings season with Apple, Amazon, Google, the big heavy hitters, so to speak. Now that that is in the rearview mirror, you'll notice they're both pointing in the downward direction. Money managers certainly more happy to allocate capital in the present day, and notice that there's more risk in the future. So that, of course, is bullish for inflows to the S&P 500. That's what I've got for you in volatility. Let's get on over to the QQQ and round out the remainder of the broad market here. What do we see in the Qs? Very similar psychology to what we just discussed in the S&P, so we're not going to beat the dead horse here. Upper edge and lower edge of the weekly expected move, both bullish, higher high, higher low, getting into the single prints, finding a higher low off of the double top from here. Very bullish from that perspective. In and out inverted hammer from Friday's session, watching for the gap to close. Then it's all about really getting to the top of singles at 299.20, closing those singles, finding the higher low. This general zone of the market is 296.50. 296.50 is your key level in the QQQs. Breaking down underneath, again, the risk becomes a lower high and a head and shoulders type pattern from this perspective right here. If we move in the upward direction and just blast through the upper edge of the weekly expected move, 320.50 is the target. And then I'll just update you on the Wednesday video if we've got to search for something higher than that. Let's have a look at the IWM Russell 2000 and the small caps. Remember that this is really a risk on indication because small caps inherently have more risk associated with them. So if this is outperforming, that is bullish for the market as a whole. Notice that we made a significant higher high well outside of this area. The lower edge of the weekly expected move is well above the top of this balance area here, and this also produced an inside bar on Friday as opposed to the in and out inverted hammer that we've been discussing on the SPY and the Qs. So once again, this does not mean that the market has to hold up. It doesn't mean that the market has to blast off and go to that SPY 426 area, but it would be a feather in the cap for the buyers to say, hey, the underpinnings of the market are definitely more bullish than bearish. We could experience a reasonable pullback, but we still should not be expecting that the market breaks down and necessarily goes to zero in the coming weeks worth of trade. Look at all of the support underneath us as well towards the towards the top of the prior balance area in here, breakout point, pullback from in here, the low of the FOMC rally, just tons of stuff going on in this general area. So even if we breach the lower edge of the weekly expected move, not the end of the world to find a higher low in the IWM at 188.90. I do want to share with you on today's episode the weekly charts side by side just to get the idea of the structure underneath a SPY. Inverted head and shoulders on the weekly time frame chart. You could also look at this as a very sloppy higher low double bottom above the neckline. QQQ, weekly double bottom above the neckline, should be gunning for this 330 target from the weekly perspective. Again, not advocating that we just blast off to it in the coming weeks worth of trade. IWM, double bottom over the neckline. It's basically come into that 200 target. Could see some pullback, not the end of the world. Higher lows, want to do something like this and respect that neckline. Here, higher lows, want to do something like this and respect that neckline. Notice that in the SPY, it's not so clear, which is why we made it a point to talk about $403.75. Line in the sand from the daily perspective at $400.75. Must hold, no ifs, ands, or buts about it on the weekly chart. 390. Low, higher low, possible higher low right here. That's the broad market. Hopefully you've enjoyed it. Let's dive into the companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll dive right into Apple. Certainly a crazy day on Friday following up earnings with a massive move in the upward direction, coming right into this prior area of resistance here. If we do get continuation early on in the week over 156.50, there is some room to run to this next target, which is at 163.75. I would exercise some patience, though, on just jumping right into longs, noting on the hourly time frame chart, we did start to experience some pullback, a breakdown of these levels. We don't really have much structure to support us until we come into Thursday's high, much closer to 151. Falling into Thursday's range, the next trade, of course, is for the gap close underneath, but one step at a time. The amount of volatility that was injected on Friday, let this thing kind of simmer down and show us some better structure to trade. Next up, we've got Netflix. What's going on here? Certainly a big failure in the upper wick of Friday's range, noting that we closed back down underneath the prior pivot high here at 368.50. Once again, going to the hourly time frame chart, illustrates quite clearly massive morning run, but not sustained into the close, back down inside of this range. The threat is for a breakdown of the neckline of what's now a double top at 352.50. Going back to the daily chart, you can see this clear as day. Touch 1, touch 2. Here's your neckline. Taking it out easily puts us back down around 333 in Netflix, which is still fine from an overall daily trend perspective with lows, higher lows, higher lows. Could easily find a higher low from a weekly perspective, daily perspective at 333. Next up, let's have a look. And by the way, if this does continue in the upward direction, which again, based on that upper wick, probably not a high probability outcome, 395.50 is just the next number to have. Next up is Tesla. What's going on with the untouchable, which is of course becoming now more, well, you can fill in the blank. Certainly two balance days back to back here, closing right in the midpoint of that range. So very simply put, you're watching for a break over 197.50, the 2-bar highs, to get back up towards this area of resistance here, 227, quite a ways and quite a range overhead to be trading for, or a breakdown underneath 182.40 for the shorts to try to step back in and push prices to 170. Based on the most recent squeeze, the gap and go from earnings, I'm not sure I would overstay my welcome on a short trade underneath 182.40. Just doesn't seem like the risk reward is there if you're looking for some sort of big collapse in Tesla. I think the squeeze is a little bit too powerful at this point in time, really stemming from the gap and go from earnings. Next up, we've got GOOGL. What's going on here? Gapping down on the Friday session, but closing the gap, closing inside of the gap, not inside of the Thursday range. very, very tricky chart here to be looking at. We've got a gap overhead, which is coming from back in history. If I scrunch this up, you can see from over here, we've got a gap underneath us. So it might be tricky in between those two areas. The primary zones to be focused on are the highs of this range, 108.25, or the breakdown underneath 102.60. The hourly chart is not so helpful when we look at this. Overall, once again, just indicating not a whole lot of acceptance in the Thursday range, but closing here, still over the gap up from what happened with the Meta earnings, right? So kind of all over the place in no man's land. This would be another candidate for using some patience and letting better structure unfold. Next up is Meta itself. This is still the hourly time frame chart, just pointing out that we have an hourly double top and we've closed in the midpoint of the trading range right here. Back to the daily time frame, you can see that we do have back-to-back inverted hammers. We would call this a tweezer top. If we do start to break down underneath the low, just leaving this zoomed out so you can see the structure, massive gap underneath us. There is some structure coming from this area, but based on the gap telling us that we have not traded through that recently, I wouldn't put all my eggs in one basket and go in all in at 170.28 or 169.89, but those are the numbers in the gap zone. The gap closes at 153.65. If we do just consolidate sideways and break the top, your target is 201.80, and the next one is 219. Once again, this might be a patience play, just waiting for something outside of the 2-day range here. Next up is NVDA. What's going on with NVIDIA? Not making a new higher high, inside bar, not making a new lower low. Patience is the play. This has been on absolute fire to the upside. Could it cool off? Absolutely. Is your risk reward ideal for chasing new money longs? Not really. If we do break down underneath this low, the pullback is all about 192. 192 comes from our hourly time frame chart. It's where the most recent kind of leg up started from after this meaningful pullback on the slight gap down from the close of Monday last week, right? So overall, 192 is your line in the sand, must hold there. Ideal higher low pullback, 199.75 is A-OK on the daily time frame chart. Good to go. Bull flag consolidates here. Break to the upside. Gap overhead 225.50 closes at 230.65 as your next major target. Earnings further out on NVIDIA as always. Softy. Big improvement, making a move all the way back up to the top of the range here. Definitely inverted hammer as of the Friday session, so watching that gap to close underneath, but we've resolved this kind of tricky area of the chart. I wouldn't be surprised to see a higher low pullback and a reattempt here. If that's the case, you could start to think of this as a cup and handle and look to go with breakouts over roughly the 263.25 area. Overhead target here, the meaningful one, is 279. If we don't hold up at 249.50, back down in no man's land, I would not look to be overly aggressive one way or another inside of Microsoft. Last but certainly not least is the mini beast. We've got Amazon, then a couple trade ideas for you. Same idea as what was it, Google that we discussed, getting a gap down, closing the overhead gap, and then closing weak on the lows. Definitely not a bullish look for Amazon stock here. Could we be finding a daily higher low over 99.25? It's a possibility, but this structure overall does not have me feeling overly optimistic about doing anything positive into the earlier portion of the week. If we take a look on the hourly time frame chart, once again, you can see clear as day, gap fills. There's absolutely no more acceptance from the buyers, sellers step up, or longs from here who are trapped decide to sell as close as possible to break even, sending prices lower. So not a whole lot of buying interest here. The next major area to hold, once again, 99.27 coming from your daily breakout area here, what was a prior flag. So overall, Amazon, patience probably again, if anything, a little bit of a short for this pullback and reevaluating 99.27. We've hit it home. Let's get into these ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all those buttons YouTube tells us to tell you about. And let's get right into these trade ideas. Thanks for joining me for the midnight special. MU Micron is up first. And what you'll notice is this is probably a longer time frame trade idea. Prior support, turn to resistance, turn to resistance. We're reattempting it after a gap and go from this most recent sort of bullish leg in the market. You could think of it as a weekly double bottom. You could think of it as a sort of monthly, really sloppy inverted head and shoulders. Anyways, the neckline nonetheless is over 64.50 as a zone up to 66. And from there, you could calculate a target at these prior highs closer to 75. So definitely looking at this as a longer time frame idea, but MU getting interesting for something to take place over this big area of weekly resistance. Next up, we have DELL, a dinosaur of the tech industry, but putting in an interesting pattern from a trend line perspective. If we do something that looks like this, I think we can go back all the way to here. Yeah, look at that. Beautiful trend line in place. It's the daily 200 SMA, and we've clearly put in a set of higher lows coming into the reattempt. As we've discussed in the SPY in the past, we have proximity of time, we have proximity of time, and proximity of time. So shorter and shorter should increase the odds, especially after higher lows, of some sort of break here. Could it happen around earnings? It's a possibility. Could it happen ahead of earnings? It's a possibility. Could it never happen at all? It certainly is a possibility, but something can be done about this DELL setup here. So zooming in a little bit, now that we know the context of the trade over 43, you could easily start to target like 45. This is a good trade for possibly smaller accounts or people who are comfortable loading up with plenty of calls. Be mindful that there is a liquidity issue on the chain here. It's not as liquid as something like Apple per se, or even MU like we just looked at. Next up is DE, another one that suffers from slight liquidity issues, but it's definitely tradable. If you wanted to grab a couple of puts, I would do so, and note that your position size might want to be the stop loss for the trade in case you get a bad fill on any potential attempt at an exit, right? So just manage your risk with total amount of dollars wrapped up in the trade. 3-bar play setting up here with an inside bar inverted hammer on Friday's session, a breakdown of 404, and we can head lower, right? We can certainly head lower. This is also aligning with, if I just draw this across, a breakdown of this area. The next major target would be somewhere around this zone 380. I mean, 20 points lower on a $400 stock, certainly worth paying attention to, noting we're already amidst the beginnings of a new downtrend with lower highs, lows, lower lows, so on and so forth, right? So this does make sense as a short setup in my estimation. Last but certainly not least is PEP, big competitor, PEP for Pepsi, big competitor to the Warren and Berkshire Hathaway Coca-Cola position, right? And the idea here is actually a long, noting that the lower wick of this bar actually undercut the low from here, did not find any acceptance from new money sellers, closed back inside of this range. And you might be saying, well, yeah, but look at it, it's a bear flag. Well, all of a sudden, what happens to the optimistic shorts who didn't get paid on the breakdown when and if we take out the top of this pattern? So let's go ahead and throw that level on together, and we'll wrap up the video at that. Over 172, I mean, we've got thin structure. As a day trade, you could look to go back to the high of the breakdown candle here at 175.25 on a squeeze, right? So certainly a possibility and worth paying attention to here inside of PepsiCo. Once again, thank you guys so much for joining me for a true midnight special. It's been, to say the least, a little bit rough putting together the videos the past couple of weeks, which is why they've come out so late. So I appreciate you bearing with me. I know who the true, viewers are, the people who are here week in and week out. Your support means the world to me, and I truly do appreciate every single one of you. I know it's hard to convey through a video, but truly, thank you so much for making the channel what it's been able to grow into, and I look forward to seeing you all tomorrow morning at 8:30 for the live pre-market prep. Once again, everybody have a green trading week, and I will see you in the next one.